Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 15th, 2016. In this video, we'll take a look at the U.S. equity markets. We'll touch on the long-term, intermediate, and short-term outlook. The main purpose of this video is to give us a trading plan heading into next week. It'll be an abbreviated trading week since I'm doing this video today. On Monday, the U.S. markets are closed, so we'll have a 4-day trading week. And later on, I'll try to do a separate video or some static posts on gold and some of the other things that are moving lately, maybe oil, and hopefully some individual trade ideas. All right, so let's. What I'll do in this video is touch on the trends. Right now, the long-term trend indicator, both the trend indicators and the long-term outlook, is bearish. Now, I want to expand on that for a second. By trend indicators, those are quantifiable. Those are not subjective, such as the outlook. When I tell you that I believe the long-term outlook is bullish or bearish, that is my interpretation of the charts, and that's the case that I'll make here. Trend indicators are all or none. In other words, I've gone over those, and I'll touch on those if there's time towards the end of this video. But those are certain things such as moving average pairs and other things that are either bullish or bearish, depending on where those trend indicators are. In other words, they're either on buy or sell signals. So right now, both the trend indicators across the board on every trend indicator that I use on all the U.S. markets, short-term, intermediate, and long-term, all but the NASDAQ 100 on the monthly, my longest term trend indicator. I use that monthly chart I've shared here. I have several different two or three, about a good three, I believe, different trend indicators that help define the primary trends, the major bull and bear markets, the major runs. And they're all bearish except the NASDAQ 100, which came close last month, but didn't print a monthly close. Now we're only halfway through February. Right now they are bearish on that time frame, but it doesn't matter. Only the end of month close. So at the end of February, if we close where we are today in the markets, even if we traded sideways for the rest of the month, then we would have confirmation there. I don't want to spend too much time. Most important thing is every other U.S. broad diversified index, small, medium, large cap, even the Wilshire 5000, which is the most representative of the stock market, is across the board bearish trend indicators. Now, outlook is different. When I go back to 2014, when the bull market was roaring, or even early 15, we were still into a solidly entrenched in a bull market. All trend indicators, short, intermediate, and long term, were clearly bullish. Yet I was bearish, making the case, the longer term bearish case, based on things such as these trendline breaks that we had here, the primary bull market trendline up breaks, the negative divergences leading up to the highs in 2015, May I think it was, we peaked out in the S&P 500. I looked at things such as breadth indicators, the percent of stocks above, if they're trading above or below their 200-day moving averages. All different types of metrics that confirmed, or I shouldn't say confirmed, but strongly supported the case that a trend change, a primary trend change, or at least a major correction in stocks was likely. So that is the difference of the outlook. Again, being subjective, you use what metrics you want and the trend indicators. But as I said, right now, in my opinion, the outlook remains bearish, and by just about all accounts, the trend remains bearish. Intermediate term, let's move forward. It's somewhat unclear right now. There are some mixed signals. So as I mentioned recently in the trading room and I believe on the front page of the site, I've been keeping it light. What keeping it light means is I'm not fully engaged in the market, in a margin account, a trading account. Fully invested or fully engaging the market, you're either 100% or more. In a margin account, you can be invested several times the amount of your actual capital, and that would be in those very good, excellent RR risk reward opportunities when you see beautiful breakdown of a pattern, well-watched pattern, and you can quantify minimal downside risk if you're stopped out. That's when you get aggressively long or short. Right now, I just don't see the risk for that, and I've stated that for a couple of weeks, and we've pretty much traded around. We've gone up a little, we've gone down a little, but we've gone nowhere. So I'm still keeping it light and moving it down now to the short-term outlook. I remain cautiously bullish. That's a term I've used for the last couple of weeks, cautiously bullish. And again, that just means that if I am in my trading account or any accounts that I'm managing, is really I'll either be at a flat or a net long exposure. Flat means you go into cash. It's just not worth it. If you can't make if you can flip a coin whether to be long or short, you should not be in the market. That is just a quick way to go broke, is over trading, especially trading when you can't make a solid case to be long or short. Now, cautiously bullish means that I'm leaning towards the long side and have been. And so that gives me, a net long exposure, but keeping it light. Net long, but not fully invested. So that's enough on that. And I'll go ahead and we'll look at the charts and I'll make the case as to why, I remain longer term bearish, but near term cautiously bullish. All right, this is a weekly chart. We'll get back to this. Let's start out on the daily charts. This is the S&P 500. And a couple things. We'll start from the bottom of this chart and move up. First thing to note, and I probably should draw it out here. See this double bottom right here in the S&P 500, or the SPY, I should say. You have these two candlestick shadows or tails right here that are trying to draw a horizontal line. You can see they're equal lows. They shot just below my support level. This is that S1 support level I've been harping on for quite a while. That line's at 181.64. Matches these just above this previous reaction low. There's numerous reactions, and we've had a double tap of that level. And if you note down here, I've pointed out recently, there's some positive divergence, bullish divergence setting up. I'd like to see the MACD curl up and start pointing up. Right now, it's sort of flattened out. We'd really have to zoom in. You can see the lines are flattened out there. So any more upside in the markets this week will have confirmed that divergence. As you can see, the MACD is making a higher low against the previous low, while price has made an equal low. And the RSI also has some divergence in place. And when you get divergence out on the daily time frame, those are pops or rallies that could last for not just a couple hours or a couple days, as you would get from a 15 or 30 or 60 minute chart. But these can go on for a few weeks or more. So that is what I call potential bullish event, let's say, or development number one. However, you can notice here on the MACD, I often talk about, it's very simple but highly effective and works on just about any time frame. When the MACD is above or below the zero line, which is the the dotted line here, it's bearish when below. And what I like to look at, I wait until the second of the two lines cross. In this case, it is the 9 EMA, which usually is a 9 EMA because that's that line's going to follow. So when that crosses below, which for example was right here. Here we only had a very brief whipsaw signal, but there it crossed below at that point, and you can see it would have got you out of this and that big meltdown. Just crossed right before it happened. And then right here, cross back up. Trend has been bullish since. So again, take a look. If I were to, you can do this, just remove that line. I won't do it now. I want to keep this video relatively short. So trend was over here. Started getting bearish. The 9 EMA fell below. Remained in bearish territory all along here and crossed back up. I don't have that red mark there. It's right about there. And at that point, it said that the trend was bullish, and it did. We rallied for a couple of months there. And again, we're deep now into this bearish territory in the MACD. So on the bullish side, yes, positive divergence. That's giving me pause. That's what I'm talking about, these mixed signals, especially in the intermediate term. So I just want to hit on that. So there's just looking at the RSI and the MACD down below, some bullish developments and some bearish developments, if you will. All right, moving up here to price, what's interesting to note is let's draw this out here, the bear flag patterns that recently played out. Now these were across the board on just about every index that you looked at, whether it was the mid caps, small caps. You had these very nice, very well defined bear flag continuation patterns. These were talked about quite a bit. In other words, let's draw it out here. Okay, this is the move down. And as I mentioned, typically a bear flag, you have the move down into the flag and then the move out of the flag. Two things happened. Now that's just a rough estimate on the measured rule. The flagpole is a swift move leading down to the flag. Now, more importantly, is the fact that when bear flags break down, those are continuation patterns, and when they break down, the move out is usually equally as strong as the flagpole or the move leading up to it. So what happened here, you notice those flags broke down, and I was quite aware of that at the time, but yet didn't jump in. The old me, as a rookie, might have said, "Oh, bear flag pattern. Everyone's watching. They're going to work. They're just too perfect," and you would have shorted a breakdown there. But look what happened: 1, 2, 3, 4. Now 5 days, and if we trade up tomorrow, those patterns are pretty much busted. And as I often say, fewer things are more powerful in trading than a failed breakout, or especially well-watched technical patterns where everyone thinks things are going to go one way, such as a head and shoulders pattern that breaks down and then boom, it moves up. We had a couple of those happen during this last bull market, and the follow-up moves were just explosive to the upside. Those head and shoulders patterns broke down, looked like a sell signal, and the shorts pile in, and then the buyers just stepped in, and you had buyers stepping in, shorts trying to get out when they realized those patterns didn't play out, and of course the high frequency trading machines take advantage of that chaos and go on alongside and just start buying and squeeze every last short out. So that's why I'm cautious here. So far, these bear flag patterns at this point, it might be a hair too early to say they haven't played out, but I checked the futures today, and I don't read too much into overnight futures because I've traded long enough, especially during these volatile periods where the Dow futures can be up 200 or more points, at night, and if you're short, you're sweating bullets. You think, oh gosh, they're just going to kill me on the gap, and then they fade that entire overnight rally overnight. So let's see what happens tomorrow, and not just how we open, but how we close the day. And if we move much higher, especially, we've already back tested that flag from below. So if we move much higher than this, I think it's safe to say that these bear flags are not going to play out. At least the symmetry has been busted. Again, the symmetry being a strong move down into the pattern, a period of consolidation, and then a breakdown, which is equally, the move out of the flag follows what the move leading into the flag usually was. It looks very similar. Okay, let's jump down to the 60-minute charts. This is the SPY. Again, now we're looking at some what I call bullish developments, and this is what has kept me leaning towards the bullish side for the last week or two here. We had, when we got down here, I put on a SPY long, SPXL, also QQQ, traded the T's up, TQQQ, that leveraged T, Apple, everything. So caught this initial bounce. I had too tight a stop, an official stop on the XPSL long. The official stop should have been a little loose, but either way, we got quite a few trades, and we hit those targets. You can see we moved up, we caught that bounce, then and we stopped right after that second target level, moved back down. Now we've made an equal low, as I just pointed out on the daily chart. Remember, I drew that horizontal line there. So the SPY has made an equal low, double bottom low. At the time we went long there, I had pointed out the bullish divergence. You can see this thick white line under here. This is actually a different line. We had bullish divergence, hence the reversal. And as I often state, I've been stating this for years and trading this way for years, in a bear market or a primary downtrend, it's usually the 60-minute bullish divergences that I wait for. In other words, the 5 and the 15-minute bullish divergences, those usually get burned through when they're counter trend trades. These are counter trend trades if we're going long because the primary trend is down. However, when we get up to the 60-minute time frame, it's been my experience that more often than not, 60-minute bullish divergences on the broad markets, once they're confirmed, especially if you can confirm it on the SPY, the IWM, the MDY, the Qs, mostly on the large caps. The small and mid caps, they'll eventually follow whatever the large caps do. That's where I like to go long. So we got that bounce. Now we came down here, made another low, and two things happened really. The purple lines right here, this purple line from this point to here, price is making a lower low against the MACD, the RSI, my 13.3 trend indicator, histogram, everything else making a higher low, i.e. positive or bullish divergence at that point. And if you look at go back here, forget about the other lines, the lows back at these points, in other words, I probably should have colored these lines yellow or something different so you can see what I'm looking at. Let's do that here. Okay, from here to here, really from this point to this point, and actually goes all the way back here and here. Yeah, right there. So from this point to here, we've made a lower low in prices, and we've made higher lows on the MACD. So this is an even more powerful divergence. And if really these lines here and here, those are the divergences I just pointed out on the daily chart. That's not coincidence. This point right here to this point, at least, if not from here to here, shows the bullish divergence on the daily chart. So there it is, guys. 60-minute divergences on the SPY, both in the short term, a little bit longer term building, potential divergence on the daily chart. As I said, I want to see the daily MACDs curl up, and that could lead us to a bounce that can and last for several weeks possibly. And my first target, well, I don't want to say first target. We're at resistance now. I'm not haven't prepared any targets at this point, but I could easily see us going back up to this 194-ish level. And again, since the overall trend is bearish, I wouldn't be looking to play any more than that. I do have, as I mentioned for a while now, I've had some long exposure and the broad markets, Biotechs, some other things here and there. But we could chop around too. This could be just a consolidation range that goes on for a little while. And then the next major sell signal will come under a break of these levels, these recent lows, as well as the lows in the Qs. Okay, now, so we started on the daily time frame. We zoomed down to the 60-minute, making the case why I'm cautiously bullish. And now let's look at the long term, and let's just not forget the big picture. We are, at least by my metrics, or at least my opinion, because we haven't dropped 20% or more, but most likely we're in a new bear market in the early stages. That is, bear market that's going to take us a lot lower, probably down to at least to 155-ish on the SPY over time, and it may take a while to get there. Case has been made many times over. Trend line, primary uptrend line breaks. Everything else I've stated. This is something else I talked about a minute ago on the MACD, where I think we were looking at the daily time frame, if I'm not mistaken. And I mentioned how I use a PPO in lieu of a MACD on the weekly time frames, and it works very similar. In the same story, it moves above when the PPO is trading above the zero line. That is bullish, and when it's below, as I've highlighted here in these boxes, that is bearish. So here's the bear market back in 2007, 2008, and that told us throughout the bulk of that bear market, both of these lines, and like I said, I like to use the second of the two to cross, so that would have been the white line there for confirmation, the 9 EMA. So that was in bear market territory. This was bear market territory. The SPY didn't fall a full 20%, but the small caps and mid caps actually fell over 20%. They had a bear market back then. The SPY almost did. So did the Qs. It came close. And either way, it was a heck of a downtrend, and that warned you at that point. Now, if you zoom in here, and again, keep in mind, I didn't highlight everything above the zero line, but just by that simple metric, it told us here the PPO traded above there and captured that entire trend, confirmed the trend was bullish. Now you can see both lines, especially the 9 EMA, which follows, has moved down below, came up and back tested, and has now rolled over. So this is what's giving me pause. This is why, even though I see those 60-minute bullish divergences, I'm not loading up on the long side, because I've traded bear markets before, and just when things start to look rosy and just when everyone lets their guard down, that's when, boom, the next big wave of selling hits. So right now, the PPO at both lines are pointed lower. Clearly pointed lower. They've not flattened out. They've not turned up. Even if they did, they couldn't put bullish divergence in at this place, which is what I'd like to see to confirm, or at least help support the case that a bear market may have ended, would be bullish divergence like we had. It's not here. Yeah, here it is. Back in the 2009 lows, we had positive divergence on both the PPO and the RSI, and that marked the end of the bear market. This was just a correction. So that's that. There is some divergence there on the RSI, but the RSI, again, moves around. I'd put a little more stock, especially to see a crossover on the PPO. But that's what I wanted to point out. Another thing that's giving me pause, and not pause, I should clarify, my longer term outlook remains bearish, unambiguously bearish, longer term. What we see here in a bear market, even during this, early shot on here, we had almost an oversold reading, but not quite. We never hit the 70 level. We were very close. This was oversold. We had a weekly oversold reading that came a little bit before the bear market ended. Remember, there was a big bear market rally in the fall. We got oversold at that point, and we came back to make another oversold reading that's 70 or below. I'm sorry, 30 or below on the RSI, and that also put in that positive divergence. During that strong, powerful correction back in 2011, we hit the oversold level. You can see that tag of that 30 level there. We've yet to hit it here. So by just about every metric that I use, we're in a bear market, but we haven't even hit the RSI, the 30 level. And I expect that to be hit much more than once in a bear market, or I should say, at least twice. And we haven't done that yet. So this is, again, something that just to point out that I could see any rally that starts to get going here could break down, take us down to this next target level, and then maybe hit the 30 level on the RSI. And once I see us move back above there and there's some other confirmation, that's when we can get in for one of these nice tradable bear market rallies like we had back here in 2008. Here's one that was, this was 13% on the index. So you give me a 13% move on the S&P 500, and more often than not, I can parlay that into a half dozen or more long side trades for 30-40% gains on a lot of individual stocks with the best looking setups. Higher beta issues. This is just diluted down with utilities and dividend paying stocks and everything else. So again, you give me a 13% rally and put me on the right side of that, and I'll find quite a few stocks that do much more than 13%. So that's what I'm waiting for, and I just have to wait patiently for that time to come. Qs, this is the QQQ. Might as well just stay here on the weekly time frame. Same story. There's your primary, the yellows, primary bull market uptrend line. It was a divergence at the top. Gives you that rising wedge pattern at the top. From this point here, negative divergence, just like we had in all these other cases. We had these divergent highs. They were followed by corrections. Just follow the horizontal line, the vertical line up, and you have these divergent highs, corrections. You have the PPO in bear market territory. Now, as I mentioned, of all the broad diversified indexes out there in the U.S., small, mid-cap, large-cap, Wilshire, S&P, they're all clearly in bear market territory, all the readings that I use. And the Qs, as I mentioned, is the one holdout on my longest-term trend indicators that has yet to give us a monthly sell signal. And you can look here, look how well this PPO works. The Qs were the leading index on the way up throughout the entire bull market. And lately they've been coming down harder, falling harder than the more diversified S&P 500, which is, I just pointed out, in bear market territory on the PPO. You can see here how well this 9 EMA, again, focus on the 9 EMA on the PPO, crossed over at this point. I should move up here so you can see it. Said we were in a bear market right about here, and we had a little rally from there, but the 9 EMA stayed below, said stay short, tried to come back tested that zero line right here, moved back down, and at this point, it told you the bear market was over. Again, a simplistic view. I never use any one standalone buy or sell indicator or I should say any one buy or sell indicator as a standalone buy and sell signal, but just as confirmation, bear market. From that point on, amazing. All along with all these corrections that we had, not once do we have a solid, maybe a week or two, but for the most part, that 9 EMA stayed above the zero line, and now we're just crossing below it. I think you can see here, zoom in, but not by a whole lot. So how we end February will has the possibility to either put the Qs on a long-term sell signal or not, both by this metric and the trend indicators that I use on that monthly chart. And you can see here the Qs aren't even close to being oversold. They're only at 30, almost 37 right now on the RSI. This is what you want to see in a bear market. You want to see a pretty nice flush out. So I think there's a lot of downside. And again, I'm looking at everything building up to that and everything else we looked at. So Again, when we get oversold, and I see us move off oversold levels, the first time around that we hit it, I don't expect to see this divergent low, but anything's possible. Again, I don't want to get too far ahead. That's just longer term, making the bearish case. Let's look at the daily chart real quick. Daily chart, here's those bear flags that we had on just about every diversified U.S. index. Beautiful looking bear flags. This line here and this one here. This was the measured target, as I mentioned, from that the flagpole, the impulsive selling down into the leading up to the flag. This is what those expecting the bear flag breakout to do, is bring it down to this level right here where that measured. Again, just using the the typical measurement projection of a bear flag pattern. And so what happened is we did break down, and the breakdown was impulsive, and that would just get the juices flowing in any bear, in my opinion. But again, I just had a different read. Something in my gut told me this one might not play out. There were things that gave me pause, so I remained cautiously bullish. And look at this. So far, they foiled that bear flag breakdown, because you want to see an impulsive move. Sure, you can have a day or two against the trend, but so far it broke down hard, gapped down the next day, and has been holding and really, like I say, foiling that breakdown, because you want to see that impulsive move out, just like you saw leading up to it. What we do next week can determine a lot. If we start moving even higher, then I think it's safe to say that that bear flag pattern, at least in the way they usually play out, will have proved to have been a false sell signal. And if that's the case, then you're going to have a lot of short covering, a lot of people that piled in short here and took that, expecting a much sharper move down. And I also mentioned that this coming Friday is options expiration week. Think how many people started getting bearish. I mean, this is where you wanted to be bearish, at least with the break on this trading range. He had quite a move down, so I'm sure there were a lot of put buyers here, and they need to be, for lack of a better word, roasted. That's what the put sellers, the smart money on Wall Street, the institutions, they sell puts, and the public buys them. So what they'll do, if they can hold the market up into Friday, especially bring it up, a lot of those puts that have been purchased will expire worthless, and then that's when we can get our next leg down. So I can tell you that if I'll remain net long going into this week. But I can almost assure you, unless I see something that convinces me otherwise, I'll be lightening, if not closing out all that long exposure come Friday during options expiration date. So here's the look at the potential divergence. You can see the MACD starting to curl up there. Hasn't all the way yet, hasn't confirmed that divergence by a bullish crossover, but it's looks like it's poised to. So there's some potential divergence on the daily chart. And if we take out, like I said, this is the S1 support zone. I had that S1 level on the SPY. If that goes, this is my next support level here, S2, about 91.16, and then this S3 level. And, again, longer term trend is bearish. Anything can happen. And in a bear market, you have those waterfall sell-offs and periods of consolidation, sometimes a bear market rally, some short covering, and then boom, the next one down. So I'm on guard or on alert for anything that happens. All right, take it down to a 60-minute time frame. This is where we went long Apple right here at the lows, went long TQQ for a bounce. If I'm not mistaken, I know I did personally, but I believe I posted closing my that TQQ bounce as well as my Apple long. We got up there, so caught that initial bounce, and that was because we had beautiful divergence. As I said at the time, that's where I go long, 60-minute divergence during a downtrend. We had the 60-minute divergence confirm, hit a support level, bounced, came up, tried to take it out again, and failed. Bear flagged right here. You can see this consolidation with that sharp move down, bear flag. I believe that was pointed out also, at least in the trading room. Breakdown, beautiful. That one worked. And since then, look at the steep divergence setting up, almost divergence. We didn't make a lower low in prices. It was almost an equal low, but it was slightly higher. So I'm not so crazy about that. But with that being said, there's some resistance around there. If we can take out these lows from last week right there around 98.50, we might punch up to at least this level. So we'll see what happens. Okay, here's IWM. We're still on a 60-minute chart. That corresponded with that last time we went long here. On the official long trade ideas, That was a very nice descending price channel with a divergent low. You can see the divergence here. Got a little pop, faded back down, set up sort of like a bullish falling wedge pattern here. But again, 60-minute charts show nice divergence in place. And just like I showed in the beginning on that SPY 60-minute chart, we can take that divergence really and extend it. So there's small divergence there, if you will. But here, from this point to this point, price is making lower lows from here to here. And all the, just about every price indicator and momentum oscillator making a higher low. So we have, and I could do it there as well. So you can see, so the bullish divergence actually extends all the way from this point here, this right here, down into this low against the price and momentum indicators and oscillators there. So, that could easily take the IWM up. This is be pretty formidable resistance here around 101.50, 101.40 level to watch. Could go a little higher. So, from these charts alone, if I was only looking at these 60-minute charts, not taking anything else into consideration, I would be aggressively long at this point. However, it's those long-term charts that are still giving me pause. And the fact that primary trend is down, so don't fall in love with longs. Don't stay late to the party. I tend to take profits quicker. Breakouts, if they do work, tend to not play out as far and as long as they do when the trend is on a bullish trend, in an uptrend. So just be careful. These are counter trend trades at this time from a longer term perspective. Here's the IWM on a daily chart, daily time frame. You can see here's that bear flag pattern here. That's really with this leg of the flag. And look at that. We should have really played out there, but we hit this resistance level. Support level right here. And this, again, was one of the things giving me pause. Now let's look at a 2-day chart. There's some, see these reactions back here. So we hit that support level. And so far, nice reversal stick. The IWM was up almost 2% on Friday. And that's not what you want to see coming out of a bear flag. So, if we turn down immediately tomorrow and into next week and sell off impulsively, maybe that bear flag plays out. But if we pop up tomorrow and we move up much above this level here, 98.12, that's more than likely a foiled bear flag breakdown. So, all right, let's wrap this up. It's getting to be a little long. MDY, there's the flag on the MDY, the mid caps, your mid cap traders, and so far that looks like they foiled that one as well. This is a daily chart we're on. You can see the potential divergence. The MACD is starting to pinch. Turn up. If it can turn back up, you have some bullish divergence in place. Well, no, you don't, because you had this little errant spike here. But either way, you can see things are starting to turn up there, and similar to the SPY and the Qs. Okay, another reason for being cautious here and leaning, at least in the near term, bullish. I posted this chart last week or the week before. This is the CPC, the put to call ratio index, and so that's the put to call ratio index up here with the S&P 500 laid over below. Getting bearish. I had pointed out for quite a while all these tags at this red line here, just a certain low level when you reach these bullish extremes. And sure enough, those played out. That one was posted on the site. We had a heck of a correction there. And that really, so far, this cluster, this triple tag here, marked the top of the market. Market has yet to see those highs. So that was just a cluster of extreme complacency, i.e. bullishness in the market. And then recently I put a line up here, and I put it just under the 150 at about the 148 level. And the dotted lines mark all the troughs in the market during these sell-offs, and you can see during these lines we usually had a rally right after that green line was hit. And what this is, again, you have excessive fear, excessive put buying, a lot more put buying than call buying, because the markets are going down. And when everybody gets bearish, you can see, just follow the lines. I'm not looking for huge bounces again, because the primary trend is down. But if you measure that out in points, these are substantial bounces here. This one, it didn't, and they don't always come right away. This one, it took a little longer, and then we had a nice bounce, nice move up. Usually there's at least some initial bounce, then maybe another leg down, and then the big move up. But again, keep in mind, this was bull market territory from 2009 on. So after you got the initial bounce, you had, the trend resumed. The case has been made that we are now in a new bear market. So at the very least, and we did, if you look at the last one, we did get a bounce. This was that last reading above 148, and we had a nice bounce. And it may not look like much on this chart, but excuse me, I think it's about, oh gosh, that's about 1820, 1830, somewhere in there, from the lows all the way up to this level, which is about 1950 on the S&P. So it was quite a bounce, and that was, I warned that day that it happened. So we had that bounce. That may be it. We could be heading lower. And again, it's just too close to a coin toss here. So I'm looking for just a little upside next week, possibly into the end of next week. And I'll do an update next weekend or on Friday and share my thoughts there. But let's just say this is the best way to describe my trading right now. Near-term bullish, net long, but driving with one foot on the gas pedal and one on the brake, meaning I'm ready to, if I have to jump out of those longs and turn around and get short, I'll do so, or at least go flat. Okay, we'll leave it here. Just one of the sectors that I still think looks good if we are going to see a pop here are the biotechs. XBI is a one-time ETF. You can trade it. You can trade the leveraged ones, but if you're going to be in it for more than a few days, you're probably better to just buy the short the inverse. If you're going to use those leveraged ones, short the opposite. In other words, short the short ETF LBAD to go long. Or you can trade the XBI and just buy it on leverage. If you have a margin account, you can buy 3 times as much, and then you don't suffer the decay. So that's another option for you there. But there's the XBI I mentioned. For a while, it's caught support at the bottom of that support zone that I have, and the 60-minute chart looks pretty good. Given we had a divergent low, we did get a pop. That was a nice pop, actually, off that divergent low. We went in, put another divergent low, and which was pointed out, and we did, again, get a pop. Didn't go as much as I expected, and now we're at another divergent low, and really what I've done is extended this line, so this is really one more, larger, I should say, more powerful divergent low than these other divergent lows that I had. Those lines are gone. So in other words, you had a divergent low here. You can do each one. So the biotechs, if the market can hold up and rally into next week, I think they have more upside than just about anything out there as far as sectors I'm looking at. And I could easily see a move up to this 52.16-ish level. Possibly higher. Again, it depends on what the broad market does. So that's one trade idea and one place that I have a little bit of long exposure now. I think that's it. If I want to cover anything else, I'll put it in static posts. This video has gone much too long. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.